Tips for evaluating rental properties cash flow and returns to investment. Tips when it comes to investing in real estate for rental. In the realm of real estate investing, understanding the dynamics of rental properties cash flows and return investment, or ROI, is paramount. Whether you are a seasoned investor or just dipping your toes into the market, mastering the art of evaluating these factors can be a difference between lucrative venture or a costly mistake. We'll delve into the tips and strategies that can help you accurately assess the cash flow and ROI potential of real estate properties. Number one, let's start with understanding cash flow basics. Before diving into the world of rental or property investment, define your goals clearly. Are you looking for long-term appreciation, intermediate cash flow, or both? Understanding your objective will shape your investment strategy and guide your property properly to the right selection process. Before diving into property evaluations, it is crucial to grasp the fundamentals of cash flow. Cash flow refers to the net income generated by a rental property after deducting the expenses such as the mortgage payments, property taxes, insurance, maintenance costs, and vacancies. Positive cash flow occurs when income exceeds expenses, while negative cash flow indicates a deficit. Second, let's calculate gross rental yield. Evaluate the property's rental income potential based on market rates and demand. Consider factors such as location, amenities, and local rental trends. Conduct a thorough market research to ensure that your projected rental income aligns with the market standard. One metric for evaluating rental properties is the gross rental yield, which is calculated by dividing the annual rental income by the property's purchase price and expressing it as a percentage. The higher the yield gross rental indicates a better potential return. Third, let's talk about the factors in operating expenses. To accurately assess cash flow, it is crucial to operate all operating expenses associated with a property. This includes property taxes, insurance, maintenance, property management fees, and vacancy allowances. By meticulously accounting for these expenses, you'll have a clear picture of your net cash flow. To arrive to a more accurate assessment of cash flow, it is essential to consider all operating expenses associated with your property. These might also include the management fees, the utilities, and also the HOA fees. You might want to subtract these expenses from the rental income. This will give you a clear picture of what your investment is going to yield. Four, let's analyze the vacancy rates. No rental property remains occupied 100% of the time. That is it's a definite fallacy. Account for vacancy rates when assessing cash flow to account for periods when the property is unoccupied. It is advisable to set aside a portion of your rental income as a vacancy allowance to mitigate the impact of vacancies on your cash flow. Vacancies can significantly impact cash flow and ROI. So it's better to allocate this potential inconsistency in your rental income. Low vacancy rates signify high demand, while high vacancy rates may indicate oversaturation or economic downturn. So you better pay attention to this. Fifth, evaluate market trends. While cash flow is essential, don't overlook the potential for appreciation in a property over a value of time. Research historical appreciation rates in areas that you are considering investing, and make sure to consider also future development plans and infrastructure projects that could significantly affect your property value. Investing in areas poised for growth can enhance your ROI. So pay attention to that. Stay abreast of market trends and economic indicators affecting rental properties market. Factors such as job growth, population demographics, and infrastructure development can influence rental demands and property value. 6. Assess financial options. Carefully evaluate different financing options to determine the most favorable terms for your investment. Consider factors such as interest rate, down payment requirements, and long terms to optimize cash flow and ROI. If you're financing a purchase of the rental property, consider financing options when evaluating cash flow. Calculate your monthly mortgage payments, interest rates, and any additional fees associated with financing. Understanding these costs will help you determine your net cash flow after all is paid during the financing period. 7. Perform a comparative market analysis. Before making an investment decision, conduct a comparative market analysis, or CMA, to assess the property's value relative to similar properties in the area. Look for recent sales data, comparable rental properties, and market trends to gauge the property's potential for appreciation and rental income. Conduct a comparative market analysis to assess the property values similar properties in the area. Analyzing this will help you determine the sales price that can provide insights into a property's potential appreciation moving forward. 8. Account for depreciation and tax benefits. Understanding the tax implications of rental property ownership, including deductible expenses, depreciation, and capital gains taxes. Consult with a tax professional to optimize your tax strategies and maximize your after-tax return on the investment. Take advantage of tax benefits associated with rental property ownership, such as depreciation deductions and deductible expenses. Consult with a tax professional to maximize tax savings and optimize your investment strategy. 9. Consider long-term appreciation potential. While cash flow is essential, don't overlook long-term appreciation potential on the property. Research for historical trends and future projection of property values in areas that gauge the potential capitalization over time. Big cities such as LA, where it's saturated, it is not hard to see how you can, although your cash flow is not going to be that high, your appreciation is going to be higher. So this way you're paying the appreciation gain as opposed to the cash flow. 10. Conduct due diligence. Finally, due diligence is paramount before finalizing any investment decision. Inspect the property, review financial documents, and seek professional guidance to mitigate risk and ensure a sound investment. Consider seeking professional guidance from real estate agents, property management, financial advisors, and tax professionals. Their expertise and insights can provide valuable guidance throughout the investment process and help you make an informed decision. Evaluate risk factors associated with the property, such as economic trends, not downturns, but trends, regulatory changes, and any potential maintenance issues. Diversify your investment portfolio to mitigate risk and protect your investment against any unforeseen circumstances. In conclusion, evaluating rental property cash flow and returns to investment requires a multifaceted approach that considers different factors. This is obviously an oversimplified explanation on how to evaluate rental properties. Always conduct your own research and consult with professionals in this matter. My name is Gary Yao, and I will be talking to you soon.